19% annualized returns over 5 years. That's not NVIDIA. That's not some crypto moonshot. That's RenaissanceRe, a reinsurance company most investors have never even heard of. While everyone was doom-scrolling about recession fears, RNR quietly outperformed 94% of the S&P 500. Today I'm giving you 2 reasons this stock deserves a spot on your watch list and 1 warning that could save you from buying at the worst possible time. Let's get into it. Reason number 1. RNR is sitting on a pricing power goldmine that most investors completely misunderstand. Here's what's happening in reinsurance right now. After years of climate disasters, hurricanes, wildfires, floods, the entire industry is repricing risk. And I mean dramatically. We're in what's called a hard market cycle. Premiums are surging. In 2023 alone, property catastrophe reinsurance rates jumped 30 to 40% in some segments. And RenaissanceRe? They're not just surviving this environment, they're feasting on it. The company reported gross premiums written of over $9 billion in their latest fiscal year. That's not incremental growth, that's a company capturing market share while competitors retreat. See, when reinsurance gets expensive, smaller players exit. They can't stomach the volatility. But RNR has the balance sheet and the expertise to lean in exactly when others pull back. Now here's where it gets interesting. Stop for a second and think about what reinsurance actually is. Insurance companies buy insurance from RenaissanceRe. That's the business model. When State Farm or Allstate faces a catastrophic loss, RNR is on the hook for a portion of that payout. It sounds risky, and it is, but the pricing power right now is unprecedented. They're getting paid more than ever to take on that risk. And this isn't a one-year phenomenon. Industry analysts expect the hard market to persist through at least 2026. That's runway. That's not a trade, that's a thesis. Reason number 2, and this is what separates RNR from every other name in the sector, their underwriting discipline is genuinely elite. Let me throw a number at you. 79.4%. That's RenaissanceRe's combined ratio. For those unfamiliar, the combined ratio measures what an insurer pays out in claims and expenses versus what they collect in premiums. Anything under 100 means they're profitable on the underwriting side. Most insurers hover between 95 and 100. RNR is printing money at 79. This isn't luck. This is 3 decades of proprietary risk modeling. RenaissanceRe was founded by quantitative analysts and engineers. They built their own catastrophe models before most competitors even knew what that meant. Today, they have what might be the most sophisticated pricing algorithms in the entire industry. And here's the part that should get your attention. They're not just good at avoiding bad bets. They're surgical about when and where they deploy capital. When Hurricane Ian hit Florida in 2022, one of the costliest storms in history, RNR's losses were manageable. Their stock barely flinched while competitors got crushed. That's not an accident, that's a system. But now we need to talk about the elephant in the room, the one reason you should stay cautious. Valuation. RNR currently trades at roughly 1.5 times book value. Now historically, the stock has traded between 1.1 and 1.8 times book, depending on the cycle. So we're not at nosebleed levels, but we're definitely not at a discount either. Here's the problem. Reinsurance is inherently cyclical. The hard market won't last forever. When pricing softens, and it will eventually, growth slows. Margins compress, and stocks trading at premium valuations tend to get hit hardest. Look at what happened in 2017 through 2019. Soft market conditions. RNR stock went essentially sideways for 3 years while the S&P ripped higher. Investors who bought at peak optimism spent years underwater in relative terms. So where does that leave us? RenaissanceRe is a fundamentally excellent company in a favorable environment. The pricing power is real, the underwriting edge is proven, but you're paying a fair price, not a bargain price for those qualities today. My take, this is a stock to accumulate on weakness, not chase at highs. A pullback to 1.2 times book value would be attractive. A pullback to 1.1 times book, that's a gift. Watch this name. Build your position intelligently. Don't let FOMO make the decision for you. If this analysis helped you think differently about a stock you'd never considered, do me a favor. Hit subscribe and turn on notifications. I release deep dives like this every week, and I promise you, the next one could be the idea that changes your portfolio. I'm Brian Justice. I'll see you in the next one.